Master, Wardens, Sir David, my lords, Governor, Alderman, Sheriff, Chief Commoner, ladies and gentlemen, it is a real pleasure and I'm truly honored to have been invited to deliver the Tacitus lecture in this magnificent Guildhall. I'm also very fortunate tonight to be among friends, including some former colleagues who know that I have a weakness for stories. So let me start with a Hollywood story. As you may know, Disney Studios were recently faced with the challenge of creating a sequel to the original Mary Poppins movie. That movie has delighted all of you, and possibly your children, for more than half a century. The producers of the new film recreated the magical nanny from P.L. Travers' books, but they also featured a new cast of characters, including a villain who could give everybody a good scare. What's a good story without a good scare anyway? That villain, yes, you guessed it, that villain is a sleek banker who is cheating his way to fortune. And in the end, of course, as all good stories would have it, the villain is defeated by a touch of magic. So here is my question. Why is the banker the villain? After all, a healthy economy requires a healthy financial sector that is at the service of people as they pursue better lives for themselves and their children. You might call it everyday's magic of finance, helping families buy a home, save for retirement, helping business access to capital, to support growth and employment, helping ordinary people manage risks and prepare for a rainy day. And that is what most financial professionals actually do on a day-to-day basis with dedication and a sense of pride. And yet, despite these good aspects, the caricature of the bad banker has resonated with audiences since the dawn of civilization. And its latest version, seen by millions of children around the world, is telling us something about the deeply felt sense of unease about the role of finance in today's world. It does not take history, sociology, or religion, let alone magic, to trace most of this most recent frustration back to the global financial crisis, which has left painful economic and psychological scars on millions of people. We know also that many people are angry about the steady drip, drip, drip of financial scandals and misconduct that have occurred all over the world. And indeed, financial globalization has been one of the key drivers of what Theodore Roosevelt called the swollen fortunes of the few, what would be today this new Gilded Age with high economic inequality and low social mobility. On Wall Street, for example, overall compensation levels have been reaching record highs yet again, and there is a similar trend of moving back to pre-crisis pay levels in other financial centers as well. No wonder that growing concerns about finance can be heard across the political spectrum, and not just about the issues of the day, but about the fundamental purpose of the industry. In too many cases, the financial sector has strayed from its original noble purpose, and too often it has worked first for itself, and second, to serve people and the economy at large. And surely there must be a better way forward, which brings me to the theme that I would like to discuss tonight. I believe that we can build a better financial sector, one that is safer, more sustainable, and ethically sound. A financial industry with a broader sense of purpose. And that goal is not just morally just, but it is economically right. Why? Because a better financial sector is more important than ever to help deliver what, in our 21st century, we badly need in many corners of the world: higher employment, greener growth, and good living standards for all. The key to achieving this goal is to reshape finance into something that is more aligned with societal values and more connected to the interests of all stakeholders, from customers to workers to shareholders to local communities and to future generations. Now, to do this, we need more than just a touch of Mary's famous Brawley. So let me propose two questions. First, how can we make the financial system safer to encourage the good and not the bad side of finance? And second, how can the financial sector support long-term growth that is more sustainable and more inclusive? I will try to address these two questions. First, how can we make the system safer? Let me begin with a simple observation. If finance is to become safer and more trustworthy, it will need to harness good innovation, better regulation, and a broader sense of responsibility. So let me start with the good innovation first. Students of history will tell us that these issues have resonated through the ages. For one, it is remarkable just how much influence financial innovation has had on human progress. Think of its instrumental role in the development of writing, of mathematics, of accounting, and probability theory. Consider Chinese paper money introduced in the 9th century, or the 13th century Venetian who eagerly bought prestiti, the first true government bonds. And think of how we can draw the line between the first stock exchanges in Antwerp and Amsterdam, to, of course, the London Stock Exchange, and to our modern investment apps that put the global financial markets at our fingertips. At the same time, history tells us about unsustainable credit booms and speculative bubbles that were driven by bright financial ideas that didn't turn out to be so good. In ancient Rome, in the year 33 before Christ, land prices crashed after noble families took out loans to bet on ever-rising land prices. Ultimately, the government of Emperor Tiberius bailed out the investors by extending 3-year interest-free budgetary loans. Sounds familiar? Sure it was in Rome? And how do we know this? Well, Tacitus himself briefly described this financial crisis in his final works. But this is only one of many examples. In the 17th century tulip mania, it was a new market for future contracts. In the 18th century South Sea bubble, it was the promise of mythical new land. In the 19th and 20th century, it was often new technology, from the railway mania to the dot-com bubble. And of course, in the run-up to the global financial crisis, it was financial engineering that helped drive a frenzy of reckless risk-taking. So when Lehman Brothers collapsed, policymakers were facing what I once referred to as a holy cow moment. The most striking thing for all of us back then, and some of you in the room were highly involved in all that, was actually the incredible fragility of so many advanced economy banks. At their very core, these firms had been weakened by inadequate equity capital, flawed business models, and the blindness of powerful men. A toxic combination that left taxpayers on the hook for massive bank bailouts. Fast forward to the present, and the real question is whether the financial system is safer today. And our short answer, my short answer is, it is safer, but it is not yet safe enough. And there are many of us here who are working hard to make it safe enough. So let me move to better regulation. Over the past decade, countries have worked together to reform the global financial regulations to help rebuild trust and restore financial health. This ambitious effort, in which the IMF, the Financial Stability Board, thank you, Mark, the G20 and many others have been involved, has made a substantial difference. Banks have much higher capital and liquidity positions. Big banks are facing tighter regulation and their leverage is lower. Winding down failing banks has become much easier in all major jurisdictions and in many emerging economies. And a big chunk of the derivative market has become significantly more transparent. This is all very good, but it is not good enough. We need further efforts to address the potential dangers of too big to fail as banks become even bigger and more complex. In the United States, for instance, the 5 top banks now hold about 45% of total banking assets, compared with just about 40% in 2007. Meanwhile, leading economists and industry experts have been calling for further increases in equity funding beyond the current capital requirements to ensure that banks can withstand a potential storm. This is a call that New Zealand has just recently heard, by the way. Others are not so sure, my own compatriots included, I have to say, because further increases in equity funding might come with negative side effects, such as reduced lending. So they say. So far, the evidence points to relatively small costs of higher capital. But above all, we must be concerned about increasing discrete efforts to roll back some post-crisis regulations. Countries need to resist these pressures. And indeed, they need to push on because more work and political will are required to fully implement the existing reforms. And as policymakers are still internalizing the lessons from the last crisis, they need to be vigilant about the new risks. For example, we at the IMF have estimated that cyber attacks could potentially lead to net income losses in the global banking system alone of up to $300 billion. Or think of a sharp adjustment in asset prices that could affect the fast-growing shadow banking sector. That part of the financial world comes with many regulatory blind spots that should be addressed. For instance, we believe that countries need to regulate underwriting standards in high-risk debt markets, including leverage loans. Now, of course, making finance safer is not just going to be about innovation and better regulation. It is also going to be about a broader sense of individual and collective responsibility. Responsible behavior has a lot to do with incentives, especially monetary incentives. And there is no question that remuneration policies in the banking sector were driving reckless risk-taking before the financial crisis. As one analyst from this country who writes in an orange pinky paper put it, he was going to be here tonight, but he had to give a lecture himself. Employ as little equity as one can, promise a high return on equity, link bonuses to the achievement of this return target in the short term, and ensure that as few as possible of these rewards are clawed back in the event of catastrophe. We know how that story ended. And we know that there is a widely shared perception that those who caused the crisis did not face the consequences, while ordinary people paid a heavy price. And many people actually saw this as the ultimate breach of public trust. So what has changed since then? Well, for one, post-crisis reforms have significantly moved the needle by better aligning individual pay with the health of the firm. If you are a senior banker here in the City of London, 40 to 60% of your variable remuneration is going to be deferred over anywhere between 3 and 7 years. And it can be reduced, cancelled or clawed back in case of poor performance and misconduct. In other words, bankers have more skin in the game. In the UK, senior bankers and traders also have to comply with the so-called senior manager and certification regime, which has increased accountability and is helping firms to set a better tone at the top. And here I would like to commend one of my former IMF colleagues and friends, Minouche Shafik, who in her role as Deputy Governor of the Bank of England under the leadership of Governor Carney, did so much to promote codes of conduct for financial markets. Certainly more can be done, from making clawbacks more consistent across countries to enhancing the disclosure of disciplinary actions within firms to creating a global code of conduct. And let us not forget the power of criminal and civil liability. The sleeping lawyer inside myself is waking up now. In major financial centers, we see a more forceful pursuit of individual wrongdoing. But the brunt of legal action, amounting to billions of dollars of fine, which makes the headline, is borne by financial firms, where it is often perceived simply as the cost of doing business. The reality is that even the toughest legal actions, I would put aside probably the criminal ones, because you cannot put a firm in custody. But even the toughest legal sanctions and the smartest compensation and governance rules cannot be substitutes for a strong individual responsibility that is grounded in values and ethics. For it is not just the tone at the top, but the response from the bottom that creates a better and more trusted corporate culture. That is why the financial industry needs what I call an ethics upgrade. Now, what do I mean? For financial professionals, it simply means doing the right things, even when nobody is watching. As one banker, a very senior one, said once to me, he said, "When in doubt, I just wonder what my mother would say." It sounds so simple, and yet it is perhaps the hardest thing to do. We all know that the word credit comes from the Latin root credere, which is trust, which is belief, which is the lifeblood of the financial system. But trust cannot be manufactured, cannot be bought, cannot be mandated. It must be earned through virtuous behavior that is intrinsically motivated, again, done or not done, even when nobody is watching. And here one could draw inspiration from Aristotle, who argued that we are all driven by a sense of purpose. We can achieve our purpose by developing virtues such as justice, courage, self-control, prudence, generosity, and honesty. And Aristotle believed that this was the key to genuine happiness. That spirit can also help achieve a purposeful banking career and a safer and more trusted financial system. But this is not the whole story. Aristotle also believed that individual purpose must always be linked to social purpose, to the common good, which is not tantamount to what a former president of the Fed assumed was right and was not, which was that the addition of the individual purposes would actually equal common good. So this applies to all aspects of our life, including corporations and financial firms. The goal of a corporation cannot be just about its narrow financial interest. It must also encompass a broader sense of responsibility, common responsibility. And it is not surprising, therefore, to see growing debates about the nature of modern corporations and the concept of maximizing shareholders' value. As the British economist Colin Meyer put it, for nearly all of its 2,000-year history, the corporation has combined a public purpose with its commercial activities. It is only over the last 60 years that the idea that profit is the only purpose of business has emerged. I believe that encouraging a broader common responsibility is now more important than ever, not just for today's stakeholders, but for future generations. Which brings me to my second question: how can the financial sector support long-term growth that is more sustainable and that is more inclusive? So let me start with a data point. Over the next 15 years, more than $24 trillion of wealth will be inherited by the millennials. And they are more than twice as likely as other generations to invest in companies or funds that target social or environmental outcomes. The financial industry has seized this opportunity by offering various forms of impact investing, green bonds, and a panoply of fund products that take account of ESG. I haven't told you anything about SDGs yet, it's coming, but ESG, which is environmental, social, and governance issues. Clearly, sustainable investing is booming, but it also points to a deeper issue. Whether you are a banker, a fund manager, a fintech entrepreneur, you are probably wondering how to take a more sustainable approach that is both economically rewarding and ethically right. And I understand that there is a national dialogue which is beginning in this country to actually understand and appreciate how those two goals can be mingled: economically rewarding and ethically right. And I believe that this offers a huge opportunity to redefine the magic of finance to pursue a broader sense of purpose. I know for a fact, because I've discussed that with many of them, that there are equity fund managers who do not believe a word of that and who will pay polite lip service to the principle of this ethically right aspect. But I support the idea that they might be proven wrong. Let's talk about innovation. I've talked about innovation, so why do I talk about innovation again? Because I want to tell you a little bit about fintech. The immediate priority should be to foster cutting-edge financial technology. You've heard that before. That means creating fintech products that are substantially cheaper, more accessible, and more user-friendly. It means serving customers and communities in new and better ways. It also means rethinking the economics of the financial industry itself. Bear with me. In the United States, for example, the unit cost of financial intermediation has remained largely unchanged over the past century, while income from finance has risen and fallen with the value of financial assets. Now that suggests a significant amount of rent extraction. The fintech response to that is to increase competition, reduce inefficiencies, and provide better value for money to individuals and small businesses. And in doing so, fintech can help drive an inclusion revolution. In Kenya, in China, mobile payment systems have brought millions of previously unbanked people into the financial system. In Latvia, in Brazil, and elsewhere, peer-to-peer lending has opened up new sources of credit for small businesses. And around the world, blockchain enables faster and cheaper transactions, from trading securities to sending money to relative abroad. And this is only the beginning of that inclusion revolution. You'll say, you've picked examples in developing countries, emerging markets maybe. No, it applies to advanced economies as well, because we shouldn't forget the 1.5 million people who in this country still have no bank account. We should not forget the 33 million US households who are either unbanked, that's a terrible word actually, it's like deplane, let's say underbanked or do not have bank account, And obviously those numbers are much larger in emerging and developing countries. So there is a huge opportunity to boost financial inclusion, which, as we know, leads to stronger growth and higher employment. And this in turn requires vibrant digital ecosystems such as London, which is home to the biggest cluster of fintech startups in Europe. Now that won't go away, whatever the outcome of what is not talked about tonight. But fintech will not do it alone. We also need better regulation and smarter supervision to ensure that fresh sources of credit do not encourage people to overborrow and that personal data is protected against prying eyes and criminals. In other words, banking-type fintech services should be subject to banking regulations, especially when it comes to consumer protection. For new firms, this means working with regulators to unlock the immense potential of fintech while managing the risks. This is the goal of what we have called the Bali Fintech Agenda that was launched by the IMF and the World Bank last October. It provides the key principles, including on promoting competition and consumer choices and fighting money laundering or the financing of terrorism, and that Bali Agenda can actually help guide their endeavour and our joint endeavour in the period ahead. And together with a few enlightened, we are going to pursue that agenda. Now, you would probably be fairly disappointed with me if tonight, as I'm talking about this inclusion revolution, I was not going to go a little bit beyond fintech. Because it also encompasses the need for more diverse leadership in finance. And I say this for two reasons. First, greater diversity always sharpens thinking while reducing the potential for groupthink. And second, diversity also leads to more prudence and better decision-making. Our own research bears this out. A higher share of women on the board of banks and financial supervision agencies is associated, there are strong correlations actually, with greater financial stability, not causality, correlation, which underpins stronger and more durable growth. And believe me, we have a long way to go. We've done the research, and across the globe, only 2% of banks' CEOs are women, and less than a fifth of bank board members are women. Here in the UK, the Hampton-Alexander Review has been urging the largest listed companies to increase the proportion of women on boards to at least 1/3 by 2020. You are almost there, not quite. Would quotas make a difference? My answer is yes, as long as they're properly designed and implemented. And a good example is that, for those in doubt, is Norway, where over 5 years mandatory quotas supported a 4-fold increase in the proportion of women on corporate boards. And clearly more female leadership is critical, and not just at the top, but as consumer of financial services. Women all over the world are making their voices increasingly heard when it comes to investing their own money. For example, recent surveys show that women are far more likely to engage in sustainable investing than men. And they're driving demand for new products, such as funds targeting gender equality in corporations. That spirit is beautifully captured by the fearless girl statue on Wall Street, which brings me to my final point. I believe that fearless action and fresh ideas are needed more than ever to invest for the global common good. Think about it. Trillions of dollars in private sector investments will need to be mobilized to tackle climate change and to achieve the SDGs, the Sustainable Development Goals, which are aimed at eliminating poverty by 2030, and more than this, making the planet just a better place for our children and their children. These goals, endorsed by the global community, almost, constitute a daunting challenge. But they are also a huge opportunity, especially